Welcome to the Broken Pie Chart Podcast, episode 336. I'm your host, Eric Moore. With me back on the program is Zega's trading manager, Shane Skinner. Shane, what's going on today?
Not a whole lot other than just, some sliding in the market. Nothing crazy, right? Just off the highs.
I think this
And a
was
lot
the
of earnings.
first day it moved more than 1%. It's been over 30 days, hasn't it? It's been a while.
Yeah, and the moving average stat too, right? With the 20-day, like we've broken records with this run up and a multitude of technical sort of aspects. And yeah, that's one of them. And it's interesting because you've seen, yesterday, right, the slide from all-time highs, right, stayed within Wednesday's range in terms of the close, right? So it wasn't like we were that far off, and then we get the gap down today that just didn't seem to want to pull all the way back up and close. So we've got some gaps to the upside, some gaps way down below on the daily to the downside.
All this started, look, the Fed had their meeting on Wednesday, and all right, they didn't do anything. They seem to indicate higher for longer. I think we saw the Fed probabilities for the September meeting go down. I feel like it was close to 90%, and I didn't look. I feel like it went down to more like 50-50. So it felt like September, maybe it's off the table now. I don't know. It feels like they're coming up with any way they can not to lower rates. Although I go back to kind of what I said a year ago on the podcast, and that's like, who are they lower? Who wants the rate cut? Well, people want a rate cut because they want mortgage rates to go down. They want borrowing costs to go down. I mean, if you own a home, you don't really, and you're in a good mortgage, you don't really care. And if the Fed has to lower rates, I always go back to there's something wrong in the economy, something wrong in the market. So I don't know. Like, I'm so tired of talking about the Fed.
Yeah, it's sort of getting a little repetitive as it has the past 5 years, pretty much since COVID, right? And I think what you're seeing is the Federal Reserve they don't want to act until something breaks. And I think there's concern that while you're seeing good numbers from some of the biggest companies and the broader index is holding up fairly well, there are other places that are pulling back, seeing stalling growth. Um, and so what I think you're seeing is like the actual real economy is kind of asking, hey, can you lower rates? Can you help us out a little bit? Like, we've been up here for a while. And the Fed's going not until like we really start to see issues. And,
Oh, you mean like
seems
when they saw issues with inflation rising and they didn't raise
and they
rates?
didn't raise rates. Right,
Come on.
exactly.
Can't
So
have it both ways.
yeah. Yeah,
They're
no,
they're
I'm
full of
with
it.
you.
What did Jim Cramer say? They know nothing. They know nothing.
Well, they have a proven track record, right, of being behind the curve.
Look, and they didn't cause inflation, and I don't think
Oh,
them not raising rates. They didn't have to do anything, and inflation would have come down. I've been through that before,
we
but
could do an M1, M2, M3 analysis and look at, you know, like see if we could forecast or do some stuff in the future, maybe on what we would expect to happen to inflation, if rates get cut, and really dive into it maybe sometime. But I'm I don't know. I think the consumer is to the point where they could use the relief on interest. At the end of the day, there are plenty of people that I'm sure would like to refinance if possible. A lot of people in homes that got in when rates were so low, 3% give or take. They're probably locked in for a while, right? They're not going to sell, or
they're not moving. They're not
why
selling.
why
Nope.
would they? Right. So you've got again. Here we are talking about me wanting to buy a house in the future, right? At 27, and it would be nice in the next 1 to 3 years to have that opportunity of, hey, I can get a decent home at a decent rate that I know I can lock myself in, and then it's also as
Counterpoint.
long as go ahead.
Counterpoint. What if lower rates cause home prices to go up?
I've been
You're no
waiting for
better
that.
off.
Of course,
You're no better off.
right, right.
And
Or if the
here's the
yields
thing: you
rise
have
on the
to,
back end for some reason, right? If for some reason the short end goes,
but then you're locked in. Then you've got a mortgage at a lower rate than is available. My point is, like, I know everyone wants lower rates, but there's a push and pull. Part of the reason why housing was able to increase so much is because you had lower rates. If you look at since, like, housing's gone up a little bit, but since we sort of crested out at these high rates, it's been stable, rising a little bit, but be
I
careful
think
what you
I
wish
think
for
so
there.
too. Yeah,
Well,
no, that's
and
true.
you've got a callable bond. I mean, your mortgage, you can always refinance that. You essentially, it's a callable. You can call that loan in. Well, not really. You can call whatever it is. You can redo it, whichever way I'm trying to say it. And if rates go down to 2%, you can go down to 2%. You can't. Here's the thing: like, if you buy your house now and it goes down, you can't rebuy your house. That's always the risk.
Yep.
But look, I mean, if rates drop and home prices go up 30%. Anyway. All right, let's go to earnings though. Let's get to that.
Yeah.
So, I mean, look, the market down today 100 points, S&P points. Apple had a pretty good, I mean, they beat on revenue. Their revenue is pretty high. Their
A little bit of growth
net
there that hasn't
little, yeah, like
been around in a while, right? So
I mean, that was that a pull forward though? Like, were people doing stuff because they were worried about tariffs? I don't know.
yeah, I don't know. They saw a little bit of uptick in business in China, I believe. Um, but I don't know, a very cautious move, right? And then sort of died down after the open, and um, didn't seem very convincing. We'll see. I'm not. That does not mean I'm saying I don't like Apple by any means, but the reaction in Amazon too. That one really bothered me. Again, it's very possible if it's a minor pullback profit takings, then we go back up. We don't know. That's why you taught me buy and hedge, right? But you know, the conference call with Amazon and the issue about not really knowing how the tariffs, not being able to forecast how the tariffs are going to affect their revenues and or just business in general. Um, I found that to be just so odd to say on a conference call. I mean, he was being honest, so good for him. But um, I don't know.
Well,
I
there's the trinket tariff, I'll call it, and
that's gonna
it
make
was
your $5 to $100 stuff more expensive, right?
well, if unless people eat that stuff. I mean, in general, we've seen pretty good data that tariffs don't necessarily cause inflation because it can affect demand. Now, when I say the trinket tariff is recently or up until recently, I believe stuff under a certain amount has been exempt.
Yeah,
So
a couple
if
$100, right? Something like
yeah, if
that.
that goes away and then, um, a 20-cent pair of shoelaces imported from China all of a sudden has a tariff, then, you know, so I don't know. I mean, so far, Amazon had said previously that they didn't see really an impact from tariffs, but we'll see. And I think this is where you got to look at the inventory levels too. A
Right.
lot of people loaded the inventories, but yeah, I mean, Amazon down quite a bit. Apple was down. Let me see where Apple closed. Amazon closed at 214.75. Apple was, in the aftermarket, and it's kind of like why the aftermarket sometimes isn't really the real market because that's just but 202.38. I mean, it was down today. It was a pretty good report. And then you have Microsoft and Meta who are spending. They're spending a lot of capex,
Yep.
but I mean their numbers were good. Their numbers were really good. They pulled back today a little bit,
I'm
which
interested to see how they're accounting for the depreciation on the chips they're buying. I wonder what the write-off period is for it. 'Cause I'm sure that's a really good way to obviously make numbers look a little bit better depending on the lifespan of them
You start talking about accounting depreciation, and our
Oh,
three
geez.
listeners went down to
Yeah.
two. By the way, that's
Sorry about that.
well, I mean, really, the it's sort of like the quality of earnings is really what you get into, and so an example of quality of earnings. Just this is not uh, pertinent to these companies that just reported, but sometimes you look at, are companies growing the revenue, or are they just cutting a bunch of cost? And ideally, you want revenue growth, you want stable, maybe falling margins. And sometimes, due to accounting things, some of the earnings that accrete look better. But people who really do this, they look at the quality of earnings. But I mean, look, I think the message though is earnings have been pretty good. They've been beating pretty good amount. The estimates now, I think I looked recently over the next 12 months, 273.70 per share in the S&P. That's 7.16% growth. Sales per share is forecasted to be 5.34%, and margins still pretty high, probably 13 and a half or so. So, I mean, I think companies, everyone thought that this was really going to hurt companies, and so far it hasn't. Like the earnings have been pretty good.
Yeah,
So,
yeah, and a lot of people feel like they're waiting for the other shoe to drop, right? It seems like, um, and with all that money going into research, development, and acquiring talent, as long as this, I guess the question I have is this another metaverse where they kind of put a bunch of money into it, the next big thing, and then it kind of flops, the stock pulls back, they reposition or configure where they're headed. Um, or is this really going down a path with AI here that turns this into, an even bigger, more advanced company and thus drive the stock higher?
I mean, look at Apple. Apple stock has not been doing as well as Microsoft, Nvidia, Meta. Google is a different thing because, in theory, the people using ChatGPT are drawing eyeballs away from their search. Um,
Yeah,
I gotta be
all
honest with
those.
you. I was in the car the other day
Mm-hmm.
and I hit the button to talk to Siri, and I was like, Siri, open the map app and give me directions to here. And it opened like a website to not even something I wanted. Like it's virtually useless. So I think if Apple just figured that out, it's got to be worth a point or two in the stock. I'm just saying.
Yeah, I think Apple has been historically, and I mean, you've been watching Apple longer than I think I've been alive, but uh, I they just seem to be the type to wait, right? And not necessarily be the first in the door for something, but when they come in, they try to be the best. And something like what they could do with Siri, right? I joke that it's like Jarvis from Iron Man, for those that maybe know Iron Man
I
from
don't
the
know who that
comics.
is, but continue.
It's the ultimate personal assistant
Okay.
in the sense that you've got the setup in front of you, and imagine we want to chart six stocks, run some calculations in Excel, place a few trades, do a bunch of these things. Like this thing helps you do it all. You wear maybe glasses or have monitors that display what it's working on. But it's the ultimate personal assistant, right? And it used to be a thing of sci-fi, and now we're very close. It feels like to being there, if not already there. In some instances, ChatGPT has a feature that you can just talk to it like Siri, and it has a full-blown conversation or takes you through whatever it is you'd like to go through. Um, so we're close. Once that interface can start interacting with other applications on command in a very efficient and effective way, it's going to be probably one of the most revolutionary pieces of technology I would think we've seen in the past 10, 15 years since the
So
iPhone.
the way this has worked, when you have these big technological shifts, and there's been, I'm talking major ones. The internet, started with, I think it was Intel developing the some of the chips and some of the other things to be able to run computing like that. But the way this works is there's sort of these big technological shifts. I've mentioned Carlos Paredes' Technological Revolutions in Financial Capital book before. It talks about these major technological explosions, things like the steam engine and different types of things. The internet, you had a lot of winners and losers. That's so the book explains. But what happens is the standards are set, and then winners are chosen, and you have sort of what the standard's going to be going forward. But then you have all these old line companies who adopt the new stuff. And I think it's going to be the same with AI. There's going to be sort of an explosion of technological advances, but then you're going to find that there are old companies, businesses that use AI to increase productivity. And so while the Meta and Metas and Microsofts of the world, they're the ones spending all the money right now. I don't know, it should accrete. But this is why you buy the whole, generally we buy and hedge. We buy the whole market. We hedge it because, look, Microsoft and Nvidia are the two top companies right now. Prior it was, Apple was the top, and Apple's still in the top couple companies there, but they're not as high as they once were. Okay, let's move on to, so a couple of things we want to talk about is, got a question recently, can I retire on high dividend ETFs? So I'm going to take this one, Shane, and then I think we want to talk about cross asset correlation, how it's closer than people think, and that's changed. Although I'll argue another route as well. And so let me go into this. So, and this is something that so high dividend ETFs. The idea is selling option premium above the market, and you're taking in high income. You're selling upside premium, and there's a trade-off for that. You give up some upside in exchange for generating that premium. And there are high dividend ETFs that are yielding some 10, 20. There's some, depending upon the volatility underlying, single stock ones that are yielding close to 100. So I thought I would just take a second to explain the difference between, and this is really important for investors to understand with anything, and that is the total return versus the price return versus the dividend percent. So if we look at something like Highball, which is HYBL, it's a combination of senior loans and high yield bonds, a little bit of CLOs from State Street. Full disclosure, we use this in some of our portfolios as a funding source to take long synthetic stock position. But if I went back and I said, let me go August 1st to 2024 to August 1st, that's today actually, and I said, what's the price change? Well, the price change, it's up 0.5%. Great. And then I looked and I said, what if you reinvested all the dividends into shares of HYBL? Okay. And you could do this with any, I just picked this because I'm familiar with it. I'm not telling you to buy it. Like I said, we use it in some of our portfolios, actually our buffered portfolios, which if you're interested in that, you can send me an email, derek.moore@zegainvestments.com. That's DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, Apple, A as in Apple. Investments is up to you to spell correctly. Okay. But the total return here, 8.27%, kind of rounded up a little bit. And so while the price is up 0.5%, when you include the dividends, which you have to do, a total return is what an investor, everything including dividends that they received and including any sort of change in the price. Now, somebody might say, well, what if you don't reinvest the dividends? Okay. Well, let's say you reinvested them at the risk-free rate, which right now is right around 4.28, 4.3%. And then the total return is 8.13%. And then somebody else will say, well, what if you just took the money and you put it underneath your mattress. Well, essentially that means your reinvestment rate is zero. And then your total return, if you're getting reinvesting it to nothing, is about 7.98. But not to overcomplicate this, the total return is what matters. It's any price change and it's any including the dividends. And so that's first off. Then the second thing that comes about here is somebody will ask, could I buy an ETF and could I just simply live off the dividends? Okay. Well, here's sort of the trade-off. Remember, you're trading some of the upside and then we think about total return. So let's say something paid a 50% dividend. Okay. And somebody wanted to put, I don't know, whatever dollar amount. Imagine they put $1 million into it, and they say, "Oh, I'm going to get," if they believe the dividend is constant, and not always constant there. I just take $500,000 a year, and I can retire and whatever. But what people forget there is that, remember, it's the total return, and so anytime, and let's say you're selling options on something, or one of these funds is selling options, and they're generating premium, especially the single stock ones, they have the risk. I mean, everyone has the risk of the underlying. And so what happens is, let's say the underlying goes down 70%, dividend becomes part of your return. And so if the underlying goes down, it really, the dividends are included in the return. And so I guess the reason why I'm bringing this up, Shane, is that there is a difference. Understanding the difference there. And unfortunately, a lot of, like, if you go to Yahoo Finance, you go to Google Finance, or it's just going to give you the price return, not the total return. But the other is when people are thinking about, oh, I'm just going to retire off the dividends. There's total return, and when you are taking money out of an account. So if you're not taking money out of the account, the sequence of returns, meaning if you lose now versus lose next month versus lose next year versus win next year, you can juggle all those returns and jumble them up, change the order, and it doesn't matter unless you're bringing money in or taking money out. But once you're taking money out, you have what's called sequence of return risk. And sequence of return risk, and retirees have this once they start withdrawing money, is as you're withdrawing, if you lose early, you're worse off because you're taking out money and you're taking it out, and obviously you don't have. Um, so I'm going to hold off on the last point, but I just wanted to take some time to do this, and I'm talking in generalities now. I'm not really referring to any one specific thing, although I did give the one example. But I think, Shane, this is one of the things that's maybe a little misunderstood, and the importance of total return. And total return is how we evaluate portfolios, and it's when we talk to our clients, or advisors talk to their clients, they're looking at total return, Nate, or Shane.
Right. No, and what I've noticed with these is that the people who timed the bottom of that particular underlying on a pullback, and say you get a 3, 6, 12-month period of upward movement, those people seem to be much happier than, I'd say, someone who gets into it expecting, again, it just to be a really great performing thing for the first couple of months to year. And then if it does have a pullback, you're still getting a monthly dividend. You're still getting some form of return, but it can diminish and not come out to what most people would expect it to be, as you explained, if they're not doing the math right, which there's a lot of forward looking in it, and sort of having to average it out. Um, but I mean, I think they're fascinating instruments, and the fact that so many of them are now in the market, they're taking large positions, you know, in the market through options as synthetics, right? And it's, I think, having actually a dampening effect to an extent volatility in the market because of the positioning they take.
The other thing I'll mention, Shane, is that uh, I think I alluded to it earlier. The trade-off between premium selling and upside capture. It's one of the reasons why if you look at something like a buy right index, let's say on the NASDAQ 100, and there's an index out there, people can find it on Bloomberg or they can probably Google it. When I looked, I mean, that's down for the year. I think it was down about 2%. Well, the NASDAQ 100, i.e., the QQQs, are up for the year. And that one, I believe, just sells a simple covered call. And when you just sell a call, it caps the upside. Um, I I'm not exactly sure how that buy right index, but that's my guess there. But you do give up something. So, but I like the point that you made. Yeah, if you just like if you buy a stock when it's lower and it's now higher, you're more happy. Yeah,
Yeah, of course.
yeah. Like, and
But
that's one of
still,
the things
it's still a
that's missed on
derivative
these.
position,
Yeah.
right? There's upside risk or downside risk. It's a capped upside potential with the potential to pay out, um, a large or I don't want to say large, but the dividends on some of them, it's significant, right? Because it's a covered call strategy. But again, people think dividend and they think safe, right? Because a dividend means safe to so many people. For some reason, I am convinced our brains have just associated the two things: low beta, right? And just because something pays a dividend, pays yield, right, does not mean that it's without risk. And
No,
typically,
and the
the
higher the
yield is,
dividend,
yeah,
yeah.
yeah. Isn't that how risk reward works?
Right. There's a reason why the yield is that high because the implied volatility, the volatility expectations on the underlying asset are higher, and therefore the options premiums are higher. Going back to our example, Shane, of HYBL again, we're not telling you to buy it. It's just we happen to use it. We're familiar with it. Doesn't mean that you should use it. If I go and I look, the look if let's say high yield had outsized defaults or interest rates went up a lot, even though this is a shorter duration product that has lower sensitivity to rates than, let's say, if you're buying a 30-year Treasury ETF. But let's say the market value of the bonds or the loans in that portfolio went down, you would expect that to go down. You would expect it to go down. So, yeah, if you buy a fund that has an underlying that goes down, yes, you will be less happy than if you bought it and it went up. So it's yeah.
Yeah,
All right,
yeah.
last point on this because we get questions about this a lot, and I'm sort of not explicitly talking about Zega was involved in the creation of some of these, um, but it's ordinary income versus capital gains, and I think that's just one of the other things too is a lot of these products and different companies, you can go to the company websites, the ETF company, and you can go and usually they have supplemental information that is on the website. And by the way, we are not involved in Zing Investments is not involved in the managing of any ETFs right now. But it's yeah, I mean, you go on to any go on State Streets, go on BlackRock's, go on any of those, and you look at the supplemental tax information, and it's going to tell you what they're treated as. So I think a lot of the dividends here should be expected to be ordinary income. And the thing we're not giving, I'm not a CPA. I really haven't watched any TV shows that have CPAs in it. So it's not like I can say, oh, I did watch Matlock last night. So now I'm a lawyer. But it's not tax advice, but you're like, yeah, I mean, when you have ordinary income versus capital gains or capital losses, you can't necessarily use a capital loss against ordinary income. So anyway, I think we spent enough time on that, but hopefully that answers it. Just I want people to just think about, um, especially that total return, and just understanding that just because something pays a high dividend doesn't mean it doesn't have risk. You still have risk of the underlying. Like you want the underlying to go up. If the underlying goes down, you should expect these to go down. And if you're taking money out, it's total return. Like if you set up, if you did a financial plan and you were saying, I have X amount of dollars and I want to take X amount out. You've heard of the 4% rule. And I'm not saying that's the right way to look at it, the wrong way to look at it. But then if you say, if I'm taking out, 25% a year or 20% a year, just the math may not work out, especially because of that sequence of return risk. So, all right. A quick hit, Shane, and then I want to get to cross asset correlation. Apparently, you don't have this chart, but since 1980, this is from Charlie Bolello, posted this on Twitter. NVIDIA and Microsoft are 15% of the weightings in the Dow Jones. Okay, this is the Dow. Fine. Okay, I wouldn't even have talked about this if it was the Dow, but okay, we'll go with this. 1980 to 2025. And let me see, 1982, that was the previous. Well, I mean, it's been high since 2020. Okay, so it's been higher than the 1982 one, but 1982 is just under 11%. Do you know what companies were the two biggest?
Gonna go with IBM and Apple.
I don't think Apple was in the Dow back then. No. Give you one more guess.
Okay.
You got IBM right. That's good.
I'm gonna have to go.
You call people on the you has, yeah, there you go.
Yeah, that should have known. That makes sense. Telecom in the 80s.
Yeah. I'm just looking. He didn't call out all the periods, so I didn't. But Microsoft and GE, it looks like in 99, 9.1%. And then Exxon and Walmart, 7.7%. I would guess somewhere around 2008-ish, something like that. It's interesting. Okay, this is the Dow. It's not the S&P, but it just goes to show like different companies. Okay, I'm like the Dow is not a great one because companies come in and out. It's only 30 companies. But my point is like the highest weighted ones, they change. Yeah. So by owning an index,
the dominant blue chips, like there's the blue chips, and then there's who is at the very top of the list of the blue chips, and some lose blue chip status, I guess you could say. But realistically, the ones that seem to come down usually stay in the mix. They just don't seem to pull themselves back up after the fact to that leader role. No one's saying IBM's done poorly necessarily, but
here we're going to get to cross asset allocation, but I have the chapter in my book. Mm-hmm. So I'm just curious now. August of 2017. Let me take a look because I don't know why I have this chart in there. I'd have to reread this page.
I look forward to it arriving.
Broken pie chart available on Amazon, the namesake of the podcast. So Apple, 3.96% weight. Microsoft was 268. Facebook 1.9, Amazon 1.82, J&J 1.72, Berkshire 1.63, JP Morgan Chase 1.54, Exxon 1.54, and Alphabet combined, because there's two of them, 2.64. What's not in there? Come on, chip company. NVIDIA. Yeah. This is what I'm saying. Like you own these indices and you own diversified index funds. And like we do, when we use them in buy and hedge, we use the S&P in buy and hedge retirement and ZBIGs. Yeah, it's a living, breathing index.
Yeah, you follow it's the market, right?
And you're buying more NVIDIA as it's gaining in market share.
Right.
It's momentum.
So you're not missing out when, runners run, you're there. You're getting a slice.
By the way, I won't go through all these. NVIDIA is not in the top 10 of the Qs, the NASDAQ 100 either. Do you know what company it was? It was a chip company.
Intel.
Yeah, 2.43%. It was 1, 2, 3, 4, 5, 6, seventh highest weighted company in the Qs.
Stock market trivia, you could get free I would be so good at stock market trivia, I think.
I've told you this, so you'll know it. What was the highest weighted company in March of 2000 in the triple Qs?
And you have told me this, and for some reason, my brain keeps going back to pets because I asked you about pets a couple weeks ago with the dot-com bubble. I'm also
Was
thinking
not.
it's not Kodak, is it?
No, remember this is the
No, it was
Qs, so
yeah,
think more
yeah.
tech.
Intel. Was it Intel?
Nope,
Or
Sirius satellite radio.
oh yeah, Siri. That's crazy.
Imagine that, yeah.
Uh,
All right. So the reason I have this chapter open the book is I had a chapter called Why Diversification Fails, and this gets to correlations. So Shane, I know you did some work doing some research on correlations, and is it fair to say we'll just say something has a correlation of 1 when it's perfectly correlated and -1 when it's totally opposite? And so we say, 100% versus -100%, right? So
right.
1 versus -1. Yeah.
Positive, they move together more so than against each other. When they move, minus means they typically move opposite. So, um, yeah,
All right. Take us through your research.
yeah. So essentially, what we're looking at here is, long-term historical trends and correlation of asset classes versus more shorter term, specifically from the 2020 till now. Um, and the reason why I wanted to get into this is, as you know, I'm not a huge believer at the moment in, the traditional 60/40, 70/30. That's just my opinion. I think there are better ways to get either.
So where we're going historically, from the 1970s till 2020, you typically saw a negative correlation between stocks and bonds. Um, Almost no correlation between stocks and gold, really, like slightly negative. So if stocks are uh, up, gold's down, or vice versa. But it was fairly low. Bonds to gold was a positive correlation. And so the idea was stocks to bonds, bonds to gold, right? In terms of a flight to quality, if you will, or at least it seems that's how it would have played out logically based on those correlation levels between those asset classes. Um, Now, 2020 to now, we're seeing very positive correlation across pretty much all asset classes relative to one another. So what I mean by that is stocks to bonds have flipped in the past 5 years from a correlation of negative -0.2 to positive +0.4. So, almost double in the opposite direction. Stocks and gold, right? 0.25 positive. So the strengthening of the trading in the same direction, if you will, between those two assets. And then, um, there's strong evidence for stocks and crypto having strong correlation as well. Um, and then even bonds to gold, bonds crypto, gold crypto coming out with slightly positive correlations between zero point 0.1 and 0.15. And so where I'm going with this is it really feels like since 2020, the broader market as a whole, the index flows, the baskets, right? It seems like when one comes down, everything else kind of goes down, and when the other goes up, the others are typically going up too. Now, um, this isn't necessarily meaning these correlations will hold up over time. And what I did beyond this was look into some historical examples of regime shifts, if you will, in these correlations between a few of them. And I mainly focus on stocks, bonds, and gold. And so in the 70s, during stagflation, stocks and bonds were driven down, gold went up. Positive correlation between stocks and bonds, negative between stocks and gold, bonds and gold. In the 80s to 90s, stocks and bonds had a negative correlation, stocks to gold, negative correlation as well. And that is when you did see the traditional 60/40 type portfolio, 70-30, that stuff worked over that period fairly well. Then in 2008, you saw bonds and gold. Bonds essentially and stocks fell, then bonds rallied, gold rallied. Stocks obviously took an absolute beating. And then, starting in the QE era, if you will, quantitative easing era, there was essentially negative correlation between stocks and bonds, negative between stocks and gold. I'd argue that was a risk-on environment. It was a very clear risk-on environment at that point, and that's why you saw the correlation smooth back out to stocks up, bonds slightly down, gold slightly down, relative to one another. And then, since 2020, we've seen that shake up. I wanted to maybe ask you what your take is on this kind of data, and then maybe dive into a few of the structural drivers of why the shift since 2020 from the
Well,
70s to 20s
yeah,
to
I'll,
now.
I'll mention too. Some of the sources for
Please.
this include Bridgewater, PGIM, BlackRock, JP Morgan, State Street, Bloomberg, IMF. Good for them. So, I mean, look, there. Part of the reason why stocks and bonds got very, very correlated, and correlations really went to one, was when interest rates rose, and the fact that bonds were coming from such a low interest rate. So the lower the interest rate and the higher the duration of the bonds, the combination of time to maturity and then the interest rate, they were very levered items. And levered meaning small changes or big changes in interest rates would drive that. I mean, bonds are still down on a total return basis from the top prior to the interest rates going up. So I think that's part of it. I mean, you look at, what was it, 22, when stocks and bonds were both down the same amount. That's a big part of it. And I think from 1982 until really, I guess it was, sometime in 2021, that was the greatest bull market we may ever see in bonds. I mean, you could buy a 30-year treasury in 1982 at something like, an 18% yield. So I think that's part of it. But I think there are other periods where stocks and bonds are more correlated than people think. And the reason why correlations matter is when people are designing typical or traditional portfolios, the whole idea of why remember, if you do a 60-40, you've got to sell 40% of the stuff that you think will get you a higher return and then put it into something that shouldn't get you a higher return, but is there when you need it, meaning it goes up when everything goes down and you dampen the volatility. But I mean, part of it has to deal with, just where we were in relation to the bull market in rates. As far as gold, I mean, gold sort of goes through periods where it does nothing. And then, look, last 2 years, what is it, up like 50% cumulatively over the past 2 years? And stocks are up over the past 2 years. So, yeah, I mean, when I look at these periods too, like 2008, the GFC, I mean, bonds and gold rallied. Not all bonds, though. And we can kind of get into that. So, I mean, I think that's part of it. I really do.
Yeah, no, that makes sense, and I think maybe a good way of phrasing it is these correlations, while they seem to stick in shorter spurts or certain time periods based on maybe policy and what's going on in the world, um, they can sort of ebb and flow in the same direction, opposite of one another, but it's probably something where you shouldn't always assume if I'm in one thing and the market pulls down, this is a guaranteed hedge or there's guaranteed like it will pull me up, unless of course you actually have a true hedge on, right? It's very possible we could wake up and the market's down and gold is down hard, right? And bonds too. And so I guess that's really where this was driving me in terms of the point I wanted to get across through this research was that there isn't always that like unicorn asset that just if you're in it, it's guaranteed to go up when the rest of the market goes down.
Trend is one of
And that's
those
why
when you
we
test
buy
it.
and hedge, right?
And I'm a trend follower at heart, like a technician at heart, have been for many, many years. But obviously I look at fundamentals. I'm a big into the options market and volatility. But if you look at Trend had a very good year because it was short bonds in 2022. And so now if you backtest Trend with 2022's results, it looks like it's, very, very uncorrelated. And it is uncorrelated. Trend is difficult for people to hang on to because it might not do anything for a number of years and people give up on it, then it finally does. But if you backtest it, it looks pretty good. Gold is another one. If you backtest it, it looks really good. But there were years in, it was probably from 80s, 90s. There's like a 30-year period where it's basically flat, especially on a real basis. So yeah, I mean, all these correlations though. I'll give you some numbers, Shane, because it's in my book. And peak to trough, so 2007 to March of '09, the S&P peak to trough at one point was down 56.5%. Pretty bad. And you look at the different sectors, financials were down 82.5%. The best performing was healthcare. Actually, no, consumer staples was down minus 30.6. So it all sort of went down. Japan went down 52%. China large cap down 63. Emerging markets down 60. Developed international down 62. All went down. And then you look, where else can I look here? You look at the bond complex. So high yield bonds didn't do well. They were down, and this is all durations, not necessarily just short. It was down 40%. Investment grade corporate bonds were down 13.5%. The US aggregate bond, the AGG, was basically flat. The best, 20-year plus treasury bonds, something like TLT, was up 17.5%. So 2007, 2009, bonds did what they were supposed to do. The treasury complex did what they were supposed to do. The rest of it didn't. And part of why the aggregate bond didn't do that well, even though it has treasuries, it had mortgage-backed securities in there, it had mortgage-backed bonds. So yeah, and
And
that's
we all
the
know how
point I
that
make
went.
in the
Yep.
chapter in the book is
Yeah.
it sort of makes the case for sort of buying and hedging, using hedges as opposed to, because you're diversified when you buy something like the S&P. And then the other part, it's funny, we were talking about dividends earlier, but we looked at annual returns in 2008 of the highest dividend paying stocks in the Dow Jones. Okay, I just made fun of the Dow Jones. Now I'm going to use it. And GM was down 87%. Citigroup was down 77%. GE was down, I don't know, 56%. Like the best one in here is Home Depot, down 14.6. So, and that's 2008. That's not peak to trough. So, that's an example too. You're like, oh, I'll just buy. Back then, what was considered higher dividends. They called it the dogs of the Dow, the 10 highest yielding stocks in the Dow, and all that stuff went down. So I don't know. I mean, is your part of your research impetus here is to say, I wonder if things won't be more correlated going forward? Like, is that kind of your thought here, or was it just to take a look and see when does it get more correlated than not correlated?
It, I think it was more so to reinforce the buy and hedge argument and sort of show people that it's the correlations between these assets. It changes over time. It's never necessarily one for one. And based on that, like you said, you diversify and then you put hedges on, and that's where the real protection comes. Some people think, or at least I believe some people think, if you just go into gold, it's just that's the hedge, right? Or that's the flight to quality, the safety asset that you can put your money into and you'll be okay. And that's just not, I don't think, true. Like, you can't say that and guarantee it. The only time you can make a guarantee on I can't lose more than this amount is if you have a true bona fide hedge on. And when you do, that's what actually unlocks your ability to form a plan, look at, okay, this is the most we can lose, this is where we can make or what we can make, this is how much is covered, this is how much it's going to cost me on an annual basis. And, you know, why more people don't do it, I don't know. I hope more people continue to do it. It'll, I think, have more positive effects on the overall market's performance
All right.
in the
You
long
can't say
run, the more
guarantee. So let
people
me clean that
buy
up
and
for
hedge.
you. So here's the. All right. So
You
people
can't.
ask me, like, what's the downside of hedging? Well, the downside of hedging is there's a cost to hedging, and it might be 3% annualized cost. Uh, you may give up some of the upside, and you're doing that because you believe that you still want to have growth, but you want to have protected growth. But there are times where, let's say, a hedge is set 10% lower, or wherever a hedge is set, and the market comes down to that and just sits there. So, in that case, you'll have the drawdown, you'll have the cost of hedging, and let's say you rehedge from there. You're not going to rehedge right at where the market is. You rehedge another 10% lower, for example. And I'm just saying, we have different hedging strategies that do different things. But in that case, let's say you come down another 10%, or it goes up quite a bit and then comes back down. So now you're foregoing profits. Like there's trade-offs to everything, but I think getting back to the main point. So hopefully I cleaned that up enough. And if people are interested in the risk and reward and the pros and cons of that, they can go to ziginvestment.com. We have presentations that give a balanced view of the strategy and kind of what's the good, what's the bad, what can go wrong, that type of stuff. But getting back to, imagine coming into 2008, you said, oh yeah, I have international, I've got I've got US stocks, I've got different stuff. Or imagine you came into 2022 and said, oh, I have this awesome setup. I'm going to be 50% stocks, I'm going to be 50% long-term treasuries. You lost on both. And I think that's kind of one of the things. When correlation, there's a saying that correlations go to one when things start to get a little hectic. And that's true. Like different asset classes can sell off. In 2020, we saw corporate bonds, we saw some government bond funds that were trading below their true net asset value. Like they were trading below what the stuff was actually worth.
Negative oil. I'm so glad that
No,
I didn't
but that's
start
real.
on the TD Ameritrade
No, but that's
futures desk
separate. You
until
can't throw that in
after
with
the
bonds.
negative oil incident.
Yeah.
It is cost of carry, and that you're right.
And
You're right. Bonds. That's almost like breaking the buck, essentially, right?
well,
On
I mean,
like a
it's
money
but
market
the thing that
fund. I mean,
happens
that
too
stuff's
is
very
that all
scary.
has to get traded. And one of the, it's a risk with any asset class is when things get very illiquid and you've got to sell a bunch of stuff, you need buyers on there. So oil is different because let's say during that time that you could get paid $30 to take a barrel of oil or $15 to take a barrel of oil, whatever it was. You can't just take it. In fact, a Bloomberg writer, Tracy Alloway, she's got a podcast called Odd Lots, but she wrote an article I remember way back when where it was hilarious. She was like, "Oh, what if I wanted to buy a barrel of oil?" That is completely toxic to store like in your house or your garage. Don't do that. I don't. It's probably not legal, but that's the point.
I don't
Yeah,
think that's legal. I think
can't do it.
zoning
Don't do that.
would
But the
have a
point is, like
nightmare
you,
if they found out
yeah,
you were
but
storing oil
bonds
at
are a
your
little bit
house.
different.
Yeah,
But anyway, I
I
mean, it's just
yeah.
all right. I think we beat this up enough. What else is on our sheet here? But I like the fact that you went into that. I like the fact, because correlations.
Um,
You go back to Efficient Frontier and Harry Markowitz's work back in the 50s. Although I think the efficient market hypothesis could use some updating. And all your
Yeah, I
all
have
your
comments on that. I'm
estimated
just
or
going to
expected
refrain
returns
from
in your risk
speaking.
evaluation is based upon historicals, which you have no idea if they're going to hold up going forward. But it also relies on those correlations, and so everything gets correlated pretty much. All right. Last thing I wanted to bring up was U.S. net capital inflows. Who is this from? LSEG, DataStream, and Yardini. Somebody had this on Twitter. U.S. net capital inflows, total private plus official, trillions of dollars. Audience can't see this chart, but going back to 1980, okay, this isn't inflation adjusted, but it hit a new all-time high for net capital inflows. So, yeah, like there's capital pouring into the U.S. It's not. I know a lot of the narrative was with the tariffs and everything. According to this chart, it's coming in. So we'd have to inflation adjust this.
I want to dive. No, we need to inflation adjust this, and I also want to. This is spiking my interest in looking into foreign dollars and just how much they make up within our equity market. I'm interested to see, because if you remember, not too terribly long ago, we were talking about Europe and just our thoughts on that, what could potentially happen. So, if you saw Europe start to potentially pull back, maybe we see some of that money
Well, that could be a dollar
continue to
thing
come
too.
in here.
But
Who
all
knows?
right, Shane, any recommendations?
Um, I think, I mean, it's August 1st, right? So, uh, baseball, right? We're approaching playoffs. That's where my head's been at. And then obviously I had to watch the Lions Chargers last night. Um, I'm gonna recommend the book that I just ordered, which we already spoke about prior, but I just ordered Broken Pie Chart. I look forward to reading it. It is written by uh, you, and I'm I'm thrilled to take a look. I haven't the last book on markets I read outside of studying for series licenses was The Misbehavior of Markets by Benoit Mandelbrot, and it gets into fractal theory and chaos theory and argues about its presence within markets, which I'm a fan of and enjoy. Stuff like that that's maybe a little more esoteric. So yeah, you Broken Pie Chart by Derek Moore and The Misbehavior of Markets by
There
Benoit
you go.
Mandelbrot, if you want to read
I'm trying to think what I
some out there
watched.
stuff.
Yeah, actually, I've been watching more baseball recently because you're right. It gets this time of year, And, all right, I'll
Yeah,
be honest with
it's
you.
getting
I wish
fun.
we still had two divisions and two teams made the playoffs, and we had a pennant and a league championship and a World Series. Because I think what happens is
I
some of the
agree.
divisions when you split them up, you like if all the divisions were together, you would have more races, and it should mean something making the playoffs. But that ship has sailed. So yeah, there's like a bunch of teams who made trade deadline acquisitions, and now every game starts to matter, and we'll see. But yeah, and I think baseball with the pitch clock, they've really made it watchable again. It because it had gotten really bad. If you look at a game rebroadcast from the late '70s and you watch Ron Guidry pitch against Nolan Ryan, and the game took like an hour and 45 minutes because they both went 9 innings and they both threw strikes, and they just got the ball and threw it, and it got out of hand. I mean, 2 minutes between pitches, 3 minutes. So baseball's watchable. I hear this right that ESPN is dropping Sunday Night Baseball?
I think so. Might need to look into
Well, they
Disney.
probably wanted
What's
too
going on there
much,
with
and that's
that?
that's
But
one of the things.
yeah, this. I have. I mean, yeah, I have my thoughts on the streaming uh,
The
environment at this
problem, which
point that
all right,
we're in. if you will. I miss cable TV and just you pay for HBO on your cable. I miss it. It was simpler. It was easier. We're still paying basically the same amount, and it's
No, what
just
they need to do is
scattered throughout
someone needs
multiple
to
apps
create
at this point.
a super platform where you can flip just like you do in at least with the live stuff, that you can flip around just like you do with live TV. Like if the streaming experience, like I through T-Mobile, I get the free MLB package every year. I have the app. It's like, oh, I got to go into this. I got to load up that game. If I want to switch out of that game, like it's just easier to. It's not the best
Yeah,
experience, so they got to figure that out.
it's a pain.
The other thing I will say is, I think I mentioned I watched The Bear, and I finished season 4. If you like, yeah, it's in Chicago. If you like really good acting,
Chicago.
and I think it's a very, very good show. The acting is great. The people in it are great. I've heard they'll do a season 5, which makes sense the way they. I don't want to give up any spoilers, but you need a season 5. But all these actors now are kind of much more popular, so I think the challenge is going to be getting them all together to shoot. But that was. I don't think that's a real place in Chicago, is it? The Beef.
No, I think there's Al's Beef, and I shout out
Are
to
they
Al's
paying us for
Beef.
this
Also, Jim's on
promotion?
the south
Okay,
side as
we got to
well.
speak to them.
Stopped there. No, they aren't. They aren't. This is a shameless. I hope not. They're gonna be pissed. Anyways, the it's based on Al's Beef. And Al's Beef has been a staple in Chicago for about 50 years, I think, going on. But it's still kind of like downtown, very hole in the wall. You wouldn't expect it to be where it's at. And it's some of the best Italian beef you'll ever have in your entire life. Just fantastic.
Fine. We won't get paid by them. We haven't taken any sponsors since the start. We're one of the few podcasts who don't do that. So happy to get. That's all right. Mike Puck once gave a recommendation for the people who redid his air conditioning in Miami, and I'm like, the people in the Netherlands are very happy to hear that in case.
Yeah, they're gonna
All right,
call
that's
that
it.
up.
We're calling it here. Thanks everyone. Thanks,
That's great.
Shane. And yep, of course. See everyone next week. Take care. Bye.
Always a pleasure. Thank you.